Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with JJ Kinahan. How you doing today, JJ?
I'm great, Kirk. How you doing today, buddy?
Good, good. Glad to have you in the show. It's exciting to have you on. Lot to talk about today. So for those of you who don't know you, tell us a bit about your background.
Certainly. So I started as a trader in the pitch, jumping up and down and yelling and screaming in a funny colored coat back, 40 years ago now, 1985 at the CBOE. Did that for 21 years, then went to a firm called ThinkorSwim. And, back in 2006, ran all the education. We were bought by TD Ameritrade. At TD Ameritrade, I'd held every position you could pretty much hold in the trading world in terms of running platforms, running an advisory service, running the education. We started a network. And then in 2022, Schwab had purchased TD Ameritrade. And in 2022, I went over to TastyTrade as the CEO for IG North America was the parent company out of the UK, and I ran North America for them, which included Tasty Trade, Tasty Live, Tasty Crypto.
Nice. Yeah, it's funny. I a lot of overlap over that time. I know. I remember when I found out about Thinkorswim. It was right before TD acquired them,
Hmm.
and I was doing a little research, and I heard about this company, and like everything they're doing was great, great education, just well run. Just they really understood option traders, and so I opened up an account there, started using it. Like 3 months later, they got acquired by TD, which is both good and bad because TD actually was smart. They integrated the technology. They knew what they had. I actually talked to some of the people over there because there was a small thing they were doing at Toss, which I thought was really really cool. Which is if there's 5 cents left in an option, you could close it out with no commission. I was like, that's
Yep.
great. Because it's the right thing to do. Like a lot of people want to, but they don't want to pay the money because the commission. I thought it was great. I actually begged TD to keep it, and then they did, which is kind of cool. I'll take credit, even though it probably wasn't me. Um,
Well,
but yeah, it
it
was
was something.
great.
It's something we learned as floor traders, and I know you talk about it in your podcast every week in different ways, and that's about risk. And
Yep.
so one of the things we knew as floor traders was, okay, maybe you sold that option for $5. Now it's trading a nickel. You're tying up margin. And I agreed with people. It didn't make sense to pay commissions on something like that. So there was something, the first really free commission was that.
Yeah, it was really cool, and you guys built a tremendous platform, the trading platform, which they turned into ThinkPipes at TD, which also is tremendous.
Mm-hmm.
And I have to say, like your team that kept kind of following through here, which sounds like you were a part of, just did brilliant work, in my opinion, some of the best in the industry. Um, so tell me about, given that kind of arc of your career, like what are some of the like seeing where things are now, like everything's turned into a big blob, like it's just basically Fidelity and Schwab, and it's just different. Like what do you see as opportunities now? Like given all of the progression in the industry, like where everything's gone, now trades are free. Like where do you see as opportunities in the industry for potential to change what's currently existing?
Well, I think you saw a big change that started during the COVID with meme stocks. And it has continued significantly, Kurt. And the biggest change to me is the influence of retail in the market overall. And you just go back to, I'm sorry, I'm drawing a blank on what the president called not Independence Day, but the word for when we announced all the tariffs. And
Oh yeah, the tariff day. Yeah.
yeah, tariff day, and there's a very specific name for it. I kind of
Yeah.
think about what happened to the market in those following days and big sell off. One of the things watching retail traders and watching them at Tasty at the time, we saw them actually start to buy after a day or two. They were believers that this would just pass. We saw a lot of the big money managers actually being sellers. And so, this was one time when retail actually led the way. And I think the influence of retail overall has been absolutely phenomenal. But it goes back to something you just brought up in your opening remarks, and that is the education podcasts like yours, all the information that the brokerage firms are doing, spending time. I helped develop the what's now the Schwab network, at the time was TD Ameritrade network, when I was there at Tasty Trade. We had Tasty Live broadcast for 13 hours every single day, trading ideas. The thing is, there's so much great free education. I think that combined with the interest in the market, it's a beautiful circle, quite honestly. And so that really has changed the game so significantly. If you look at, when you and I started on our careers, the chance that a retail had up until now, where they have better tools than any professional had 20 years ago.
I would agree with that. I mean, the tools years ago were abysmal. The traders had them, but really no one else. And now it's just easy for anyone to jump in. But, it raises the question, should anybody just jump in? Because I was in college and I found out about options. I was like, oh, look, free money. I'm just going to go put all my money in this cheap options. It's going to go through the roof because it was 99. So back then, it was
Yeah,
pretty
good
good
a
odds
year
that
and a
was,
half.
yeah, pretty good odds that was going up. And of course I lost money the first trade. I'm like, well, that stunk. I just blew $1,000. I wasn't wealthy in college. I was like, well, that's stupid. I won't do that again.
Yeah.
So, but now people are getting rewarded for that. So like, what's, tell me about the opportunities now. Like, should anybody do it? Like, how should people think
Well,
about options, especially if they haven't done it before?
well, just like anything, can anybody do it? Yes, with the right amount of education. Should anybody do it? And the answer is no, because there is a little bit of a learning curve, just like everything else. And I've been lucky enough to speak to tens of thousands of people in my career about options trading. And one of the things I always start out with people is, do you play tennis, golf? Name a sport. Were you good when you first started? No, you stunk. And the same is true actually of trading options or trading anything. You have to learn it. So, what's the best way to make sure you learn it? Start out really small. Anything you're going to get good at, you pay for lessons. When you start out trading, you're going to pay for lessons because you're going to lose some money. So, make sure you're not paying much for the lessons. Start with very small amounts of money so you learn that way. Paper trading is actually fine, and you can place trades on paper trading. That helps you more with the logistics of how to make a trade. But actual trading, there's not, even if you risk $100, you need to get that feeling like you want to throw up in your stomach at some point. So you get used to having some risk on. Everyone wants risk until the risk goes against them. And so the biggest mistake I've seen new traders, new investors make my entire career is starting too big. Start really small. It's against all of human nature because you just saw your friend or you heard about somebody else at a cocktail party or whatever it may be that put up $1,000 and now they made 50,000. Well, you know what? That's the exception. That's why you're hearing about it, not the rule. You truly have to start small. I can't emphasize that enough for people who are new to the game.
Yeah, it sounds like the gamblers are like, yeah, I went to the casino and won 10 grand, and they don't tell you about every other day they went to the casino and lost 10 grand. Only that one time that they win.
Of course, of course. And to be honest, you had a good experience in one sense that you lost money on your first trade only because you, being a curious person, was like, hold on, there's got to be something here. What ends up happening is those people who are going to be trying to just hit a home run one time are probably going to give up right then. Whereas those who are curious are going to say, I'm missing something. Let me try and figure out what that something is. Because just like anything else in life, if it was free, everybody would be doing it. And I would say the other thing is for those who are baseball fans, I always say I want to be Pete Rose without the gambling. That is, I want to hit single after single after single after single. Those trying to hit home runs, they strike out a lot. And that's not so good.
Yeah, no, I agree with that sentiment. I think it's the thing I like about options the most is that there's you if you have a theory about where the market's going, you could create something in options around that. You can't
Mm-hmm.
do that with every investing, only options. You think the market's
Absolutely.
going up, think it's going up just a little bit, but not a lot. If you think it's going sideways, think it's going up and then down and then this and then you think it's going like whatever you think is going to happen, you could create an option strategy for it. It's wonderful. It's a wonderful type of investing.
You're hitting on everything that I love about options, 100%. And I'm just trying. The other thing I love about options is that again, you don't have to tie up as much money. And I'm kind of looking at my prices from today, and I'll pick a big stock, Goldman Sachs. and again, this is just an example. I'm not recommending Goldman Sachs, but say you were somebody who really thought Goldman Sachs was going to go high. It's trading at $723 and almost 60 cents. We'll call it 723 and a half for everybody's ease of math as you and I speak today. That means if you were to buy 100 shares, that's $72,350. Most people don't have that kind of money for just 100 shares. But you know what? If you think it's going to go higher, you can buy an option that's right at the money for about $28. That's $2,800. Now it's a little bit more reasonable where you can say, wow, I think we're going to go higher. I don't have to invest as much money. And if I'm wrong, the other nice part about it is my risk is defined on what I can use. And I think that's the stay small, number one. Number two, define your risk. Always know what you can lose going in, because people say don't be emotional in trading. I think you and I both know that's a bunch of crap. I'm sorry, it's money. People get emotional about money. But what you can do is say, okay, here's the worst possible thing that can happen. I'm going to lay it out before I make the trade. Now, at least I'm making an informed decision. Am I going to say if I lose 1,400 of that 2,800, I'm out and then get out? So you start to lay these scenarios out before you do anything. Life becomes a heck of a lot easier.
Yeah, no, I agree with that. I think it's funny because I remember I was at a TD Ameritrade conference years ago, and this is the first time because options are all about managing risk, right? That's why they're invented. They were invented to manage risk. And what do people
Absolutely.
do? They speculate with them. It's like, which is fine, right? That's
Yeah.
that's why they're there, right? They're there for people to get their piece. What I found interesting is I used to just like buy calls, or buy puts, or in many cases I would sell calls or sell I was sell covered calls or sell cash covered puts. And
Mm-hmm.
and then I went to a conference and I listened to a guy from TD talking about this, and he's talking about spreads. And I was like, huh. I'm like, that makes so much more sense. Like, the probabilities are better. Like everything's better if you're doing a spread. It's just not as much fun because you don't get that jolt of like, yeah, it went up, and it's like you get the big bump, but it's a probability wise, it was better. And I that was really eye-opening for me. Um, love that framework. And then I go to some of these custodians and you look at their risk sheet, how they rate options 1 through 4, and spreads are a 3, where 4 is like naked calls, which is
Right.
really dangerous. And it's a 3. I'm like, why is this a 3? Shouldn't this be a 1? Like it's less risky. I
Right.
mean, tell me about that. Like, why do the custodians look at things like spreads or cash covered puts being more risky than covered calls, which is also a quandary? Like, why do they not get it, or what am I missing here?
Well, I think that's part of it. I mean, actually, why are cash covered puts more risky than stock? So, but that all said, and for those who don't know what a cash covered put is, back to my Goldman Sachs example. If you thought that Goldman's trading 723, if you thought it was going to stay above 675, you could sell that put for $8. Well, if it goes below 675, you have to buy the stock, but you're getting an $8 cushion, so you're back to 667 as your break even on a stock that's trading 723. But again, playing 723 for some reason seems to be less risky. But all that said, and by the way, to your point, there's only about a 28% probability we trade down there between now and the third week of September. So I think the biggest thing that people have to remember is all options are giant probabilities. That's it. Where will the stock be on a certain expiration day? For everything we know right now, what are the probabilities it'll be there? Again, there's probabilities. They change and they can be wrong, but they're pretty good overall over time. And that said, I think one of the things about it is there's still at some firms, unfortunately, a 1990s view of any derivative product, particularly options and futures. Many people blamed futures and options market for causing the 1987 crash. And it's like, that's just kind of ridiculously silly. But unfortunately, some firms have held on to that. And you're 100% right. For those who have never traded an option before, please look at something called vertical spreads. you will not hit a home run with vertical spreads. It's built into them, but you won't lose a lot of money early either, or at least as much money. And when you're starting out, it's all about capital preservation and managing risk. And like I said, one of the reasons people, as you said, Kirk, do speculate with options rather than with just buying the stock is because their capital preservation is really important. And it's probably the most underrated thing of what the retail trader does. They're very good at managing capital once they have a little bit of experience.
Yeah, it's interesting. Do you have a favorite type? I mean, everyone's got their thing, mine has floated around over time, but do you have a favorite type of option that you find is works well for you? I know everyone might have different opinions, but I'm just
Yeah,
curious.
yeah. I wouldn't say I necessarily have a favorite type. What I would tell people is learn something called vertical spreads, learn something called calendar spreads. If you learn those two, there's not a spread in options that you can't understand because they're the basis of every single thing that happens. I will say in my retirement account, where to the point you made earlier about selling puts to buy stock, cash covered puts, I often do that. I'll just sell puts, say if I get to buy this stock at the price, good for me. If I don't, boo hoo, I was wrong and I made money because I kept the premium. And so there aren't many other trades that you make that if you're wrong in one sense, wrong, you make money. If you're right, you get exactly what you wanted, which was to buy the stock at a certain price. And so I like that trade off because there is no other area of investing, in my opinion, where that can actually happen to you.
Yeah, no, I agree. I agree. I think, there's a lot of reasons I love options, but I also like the fact they're misunderstood. What, I've seen some interesting things over time. Some people have come up with interesting ideas, but one of the things that's kind of came and went were the minis. And, so if you look at like the SPY, which I use that all the time
Sure.
for option strategies because it's basically the index. And so you could do different strategies on that if you want to be in the index. The thing that I find most puzzling is it's getting expensive, right? So it's going to cost you 50 grand to do like, like basically if you want to mirror, the index. Well, that's a lot. I mean, it's not going to cost you 50 grand, but that's basically representation. So, somebody who's only got 5,000, they can't really do the S&P unless you're doing a way out of the money, or way out of the money kind of strategy. So what happened with that? Because I'm just curious, like, why did that go away? That seems like the most obvious way to do more volume in option contracts is just because they did that with futures, they did the minis. So why not with the options? What's the thinking behind all that?
Yeah, and the futures now have the micros, which have really been successful with retail traders. The reason minis, I think they were a little bit ahead of their time, if I'm going to be honest with you. I mean, we're talking 50, probably 10 at least, I think more like 15 years ago, if I don't. It was only in six products. What ended up happening, quite honestly, was the market makers didn't want to support it because they were still getting charged the same amount of fees to make markets in the minis that they were in the bigs. And they're like, well, why would we make markets in something 1/10 the size for less margin? And I can't say I blame them, by the way.
Yeah.
And so, unfortunately, it would just nobody was ready for them in terms of clearing firms, exchanges, et cetera, in terms of how they wanted to price them. And so, with that, the fees kind of ate them up. And the SEC only wanted to do it in six names, which again, I also understand. I'm not pointing fingers at anybody. I just think that nobody was quite ready for all the implications of that. And so, I think what's been the more interesting thing that's happened over the last few years outside of the options market, which I think someday we'll get there, is the advent of 24-hour trading on equities. And basically, most NMS names now trading 24 hours a day. It just seems to me at some point in the next 4 or 5 years, we'll get there on options, at least for the bigger names also. It's just a natural cycle.
Yeah, it also kind of brings up this other thing that it really kind of sticks with me is you've got these big expensive stocks, that have $200, $400, $800 price tags, um, which I understand why they're not, changing that. but that also kind of makes it less attractive for options traders because you got to put up a lot more money, to do a strategy with a $700 stock than you would with a $70 stock. So, how should people be? Should people just ignore that if they're not, uber wealthy? Should they ignore those stocks, or are there other ways they could get in that maybe would work more reasonably?
Back to your point earlier, and again, I'll go back to the same stock I've been using for an example, just because it's easy. So, as I said earlier, if you thought perhaps a Goldman Sachs going up between now and a third Friday in September, and you bought the call that's right at the money at 720, it'd be $28. However, back to your example where you said, what about spreads? I thought it was going up. What if you bought the 720 for 28 and you sold the 750 for 11? Now you have $1,700. Now that spread can only go to $30. You're paying 17 for it. You might not want that. You might want to go further out, etc. The whole point I'm trying to make is what you can do with options is buy one and sell another to cut the cost. You cut your upside, but again, more importantly for most people, you define your risk and it's a lot less money. And I think that's the biggest thing you can do in these, as you said, uber price stocks. We have seen some of the stocks over the last few years more than we had seen cut their prices, particularly some of these high flying NASDAQ stocks. Apple comes to mind right away. Tesla comes to mind. So we'll have to see if hopefully that continues. I don't know long term. A lot of companies will tell you they're not rewarded for doing that. I would hope that they would to allow more retail to participate, not only from an options point of view, but mostly from a stock point of view. And so my hat's always off to those firms who allow the people who are ultimately the end users of their products to participate in those products. And, people want to, you talk, as you do all the time, you talk to people on the street, you talk to investors, they want skin in the game if they use a product on a regular basis.
Yeah. So let me ask you one question, then we'll move on to move off options onto futures and whatnot. But I'm curious, is there like when you're doing option strategies, is there like a target delta that you shoot for? Like, because I know a lot of people want something that's like high octane,
Sure.
but let me rephrase the question. How should people think about delta when they're deciding which option to choose for their strategy?
So that's a great question. And for those, again, newer to options, delta is a thumbnail way to measure probability. So if a stock has a 40 delta, what you're basically saying is there's a 40% probability of being in the money. One of the things I like to do, and I'm going to start from a sell side if you don't mind, is one of the things I like to do when I'm selling options, be that for a covered call, be that a cash covered put, whatever it is I like to start at about the 35 delta. The reason I like to start there is because, back, I don't want to give anybody PTSD, but think back to high school statistics and you talk about a standard deviation curve. What you're saying is you're going to sell one standard deviation because that's going to be at about, just over 65%. So for me, that's what really makes the most sense is to sell just outside what's a normal occurrence so that hopefully you get to keep that premium. And if not, that's fine too. When I buy things, I always say I buy value, sell junk. So if I'm buying a call, I want to buy if the stock's trading, $53, I want to buy the 50 call. I want $3 worth of value in what I'm paying for, and then I'll pay premium on top of it. And I'll sell from the 55 on up. I'll sell junk that has no intrinsic value. And I think when you're buying, always buy something just like anything in life, right? Buy something that has some value to it when you buy it, and sell junk against it.
Yeah, yeah, it's interesting. I mean, I think one of the things about options is there's so many moving pieces that confuse people, and it makes it hard for a lot of people to they get overwhelmed easy, and then they just go away.
I,
Um,
you could not be more correct, by the way. And I think one of the mistakes people make is they try and understand all of it right away. And what I would say is, if you were learning, because in a sense you're learning a new language, right, Kirk? If you were learning to speak Spanish tomorrow, if you didn't speak Spanish, you wouldn't expect to be speaking the whole language within 3 days. So you're like, okay, I'm going to try and learn a couple of basic sentences. And I think you have to go on your, learning journey with options the same way. And maybe you stop after covered calls and cash covered puts. You say, that's all I really need to learn. Just like if you were going there on vacation, you may just need some phrases just to get you through a few weeks, and you can go through a fine investing career just learning a few things. I mean, I would encourage people to go learn more, but again, we always have such unrealistic expectations of ourselves and our success. And I think really sitting down and thinking about it before you do this kind of stuff totally pays off, but it is against human nature.
Yeah. Yeah, no, I agree. It's a lot. So all right, and you also mentioned that you get a little involved in futures. So tell me a little about futures, because I remember when I started, there was one advisor in the whole office that was allowed to do futures. I know back in the day, it was kind of they made people take the Series 3, but after that, they said, no, you can't do it, probably because they didn't trust the brokers with the risk. And then at one point, they said the whole company, only one broker can do futures. So nobody really uses them that much in retail. It's not as common anymore, but tell me about futures. Like, what's the difference between buying like an S&P 500 futures versus the S&P 500, ETF? Like, why should people
Sure.
consider futures?
Well, I do think futures are a much more complex product. And the fact is they move really, really quickly. As one of my buddies calls them, they're chocolate covered hand grenades. And I don't mean that in a bad sense, because I do think I've seen the sell. What I've seen in futures over the last 5 years reminds me of what I saw in options 15 years ago. And it is a self-directed investor really starting to use them in a more thoughtful way. You can, just as you said, options are there to manage risk. You can use futures to manage risk. Now, you can also trade futures like a maniac and lose a lot of money, hopefully make some money. They move quick. They're a bit addicting, if we're going to be honest. And I think the one thing I would say to people, if they're going to go in and trade futures, talk about laying out a plan. Why are you buying it at this level? Are you looking at a chart? What is making you think that this is the level you should buy or this is the level you should sell? A few things about it and why they can be addicting to those who are not disciplined. You don't have to put up as much money. The margins are significantly less. But when they go against you, you have to come up with a lot of money in a hurry. So you have to really understand. And what's confusing about futures and can be, if we look at, I'll use the E-minis because they're the most commonly traded. If one tick in an E-mini S&P 500 option is $12.50. One tick in a Dow future is $5. One tick in a NASDAQ is $10. It can get very confusing. The one good thing about stocks, a penny's a penny's a penny's a penny, or options. Futures, that isn't necessarily true. So you have to do a little bit of homework. If anybody is going to go trade futures, what I would say is the /ES, the E-mini S&P 500. Why? Most investors are used to looking at the S&P 500. It reflects what you're used to looking at. In fact, one of the things I've always told people, I'm not telling you to go trade futures, but what I am saying is you should be watching that. If you're going to be at all active during the trading day, it's the first thing that moves, because that's where every big firm in the world is going in to hedge their risk, to do some other things. The E-mini moves the market.
So do the big institutions use futures because it's 24/7 or almost
Well,
24/6?
yeah.
Is that the reason they do it versus
Well,
just
that's one of the reasons. Plus, they can quickly get one price on all 500 stocks, so to speak. Now they're taking something called basis risk to cash versus the future, but they can quickly, if they need to hedge, they can quickly hedge in there. And that's the primary reason they use them. Most of the large firms are not speculating in futures. Most of the large firms are using them against other things. And I think one of the things, if you people really want to waste a lot of time, try and figure out why somebody else is making a trade. Most people don't even understand why they're making their own damn trades, and I see them trying to figure out why other people are. It's like, Why is Goldman Sachs doing this? Who knows? They have 35 other trades going on at the same time, and somehow their models say that this hedges it. So I would never worry about why the firms are buying, why the firms are selling at that moment. There's just other things going on that you don't see, and nor do you have to see. But they are going in there because they can hedge very, very quickly. Get more importantly, one of the things I don't think people have a fully appreciate. If you're doing a large order, you probably want to try and get as many done at one price as possible because it just makes all the algorithms easier if they have one reference point. So again, there are a number of reasons. You brought up, I think, one of the best things about them. They are 24/5.5. They start trading. I'm in the Midwest. They start trading Sunday at 5 p.m. every Sunday, and you get a sense of what we're thinking about for the market come Monday morning in terms of the everything overall. And most of the folks I know who have been in the business long like I am, every Sunday at 5, it's like hold on to dinner or whatever it may be. We're going to have to watch the S&Ps for the first 5 or 10 minutes here and see what they're doing.
Yeah, I'm actually curious why they don't just do it 24/7, but I know I traded them for a while, like 10 years or so ago, when John Corzine was running MF
Oh yeah,
Global. I actually wired money out of that firm like 12 hours before they shut it down. So
good for you.
I
Well,
saw a news
everybody got
article.
paid on that one, by the way, just so you know. But it took some time for
It
some,
took
so
a
I'm,
lot of
I'm glad.
time.
I'm glad you got your money out
Well,
for it.
I was actually at a conference and I was watching the news. I'm like, what the hell? And I'm like, I get my cash out of there. That's not good. It was just sitting there in cash. That was the concern. It's cash is always a danger. But anyway, but yeah, I remember trading currencies. But the reason I was interested in futures is because I was trying to trade things that I couldn't in ETFs.
Yep.
You got commodities, which are hit or miss. There's currencies, which is hit or miss. Like there was just certain things I wanted to do that you just couldn't do in stocks, and that's why I was doing them. But I realized it's freaking me out because it's Sunday night. I'm sitting there watching the screen, like, what's going to happen? And I'm like, oh God, this is ruining my life. So I had to stop doing it just because the fact that it's on all the time is like a huge addiction because you don't want to be caught
Yeah.
short. You shouldn't be in a position like that, but that's just how it felt. Like it's on all the time.
Well, two things I like about that. Number one, as I said, Chuck, I covered hand grenades. You recognized it. And number two, I think you had what most people struggle so much with, and that's discipline. And it's very difficult to be disciplined on everything in life. I mean, if everyone was, I'd be able to walk past Oreo cookies. But that said, one of the areas I think I am pretty disciplined is in my trading. And it takes some time and it takes a lot of really focus to stay disciplined in your trading. Get out when you say you're going to get out, win or loss. When you say this time is different, always remember it is different. It's the most money you're ever going to lose. And you really have to set out your parameters beforehand. And then the other thing, Kurt, you brought up why they don't trade 24/7. Don't you think I think the biggest thing that the cryptocurrencies have taught us is that you can trade 24/7 and you can just feel, I talked earlier about, equities going around the clock now or 24/5 now, along with futures. You can just feel the pressure of us headed that way, in my opinion, on the market. I think the difference being, and again, it's something I don't think people fully appreciate. Think about crypto firms. What are the most are 10, maybe 12 years old? They have modern technology. Think about some of these stockbrokers. Not that they're not updating their technology, but a lot of that technology is, we bought a firm here, we bought a firm there, put together all these different technologies. So it's going to take a longer time as the firms, the SEC, et cetera, wants to be fair to everybody who would participate. So the technology end of it is taking a much longer time on some of these legacy firms that are 50 and 100 years old than a firm that just started 2 years ago.
Yeah, I mean, as far as I'm concerned, that's their problem. I mean,
I don't disagree, but again, regulators are very conscious of fairness in the game.
yeah.
Again, I don't disagree with you, but it's something I think people just have to keep in mind on one of the reasons we don't move as fast as I think a lot of us would like to.
Yeah, I mean, I've been in the industry for a while. We're in the dark ages with just about everything. I mean, they started regulating social media like 4 years ago, 5 years ago. Like, really? It's been around for a long time, and they just got around to regulating it for the advisors. And so, technology aside, like I love like when you guys came out with ThinkorSwim, like that platform, it was awesome. And then TD came out with their tech, which I thought was awesome. They did some great stuff. I thought TD had the best tech out there at the time before they were acquired, and Fidelity was pretty good. Schwab was kind of way back there. It was like one of those legacy kind of techs that they didn't update. And so, like, I understand what you're saying. It's hard keeping up with everything, especially when you get bigger. But the big firms, they've got their finger on the scale. Like you look at the banks, like they got their finger on the scale anyway. It's too big to fail. Like they don't allow them to fail when they probably should sometimes, which I don't know what the right answer is, but it's let me ask you
I
this.
was just going to say on that, I also think you've been on the advisory side for a long time, and in the advisory side, I don't think it's quite as competitive as it is on a self-directed side.
Yeah.
Whereas just the tasty, et cetera, those if you're in a self-directed game, you are constantly looking at your technology because you're competing with the Weebles, the Robin Hoods, et cetera, of the world. You have to have great technology and quick technology. On the advisor side, there's just less firms that are in that game, and they tend to be giant firms.
Yeah. Yeah. No, I agree. It's well, I, I I'm not a big fan of the fact that the consolidation has left basically two firms and there's
Mm-hmm.
no choices. I mean, there are some, but
Yeah, I
virtually
mean,
very few.
I think you could say comfortably five with a couple of more out there.
Yeah, I mean, there's some out there, but
Yeah.
really it's the big two, and then there's some other ones that people use. But it kind of gets into the oligopoly or monopoly status, which isn't great for, you want competition. So I'm a big fan of competition. But anyway, so getting off topic. So I'm curious, have you guys gotten into crypto at all? Because I
Yes.
know that's a big thing. So tell me
Yes.
about your interaction, your experience with crypto, and how that's kind of interplayed into what you've done.
I must say, I've gone from somebody who is a little bit when I first, probably 2016, 17, when it was starting to catch a little bit of fire. I was much more skeptical. As I've continued to experiment with it, find out more about it, I think it's definitely here to stay. And those who are naysayers are just, may as well say, I still want the horse and buggy. It's here to stay. The technology, what's really exciting about it is the more people, and if there's anybody listening to this who hasn't experimented with it yet, and it's like, how do I get started? Read about blockchain. Read in really simple terms. There's a lot of people who want to take you down a huge rabbit hole, but there's a lot of really good articles, really good videos of people who are just trying to explain to you, here are the basics of what it does. And that technology is here to stay, and it's going to be amazing, and it's going to continue to help the movement of money. I think where people, I've been in this business a long time. People my age struggle with crypto is the fact that if you lose a password, you're not just calling your bank. It is much more, a libertarian type of product, so to speak, and the fact that the infrastructure on the back end for customer service really doesn't exist to the same level that it did. And I think that's probably the biggest struggle for many people in the product itself. It's not that they don't like the product, but it's a new product they don't understand. There's no customer service behind it. So it makes those who have, say, been investing in fixed income for a long time, haven't really experimented much around it. Well, it seems like the devil product, if you will, because they're going to be skeptical of things. Everyone's skeptical of things they don't understand. And when there doesn't seem to be anybody there to help you, that really makes you skeptical.
It kind of reminds me of personal computers when they came out, because when they came out, it was basically a bunch of like hobbyists, right? You built your own, or you bought an Apple IIe and you started up, and there's like this cursor blinking. There was like nothing. Like if you had a problem, who are you gonna ask? Like you go into these back then they were called nerds, but like these nerds are getting these groups and they would talk and like geek out on this stuff, which is great. Now they're like the wealthiest people in the world. So like it's a funny dynamic. But like growing up, you didn't want to be perceived that way. But like that's like that's how you figured it out. Like I had this group of friends and they love computers and we would just talk about them all the time. There wasn't anywhere you could go. Like, there's some magazines, but it wasn't the internet.
Yeah.
And so like, if you screwed up, who are you going to call?
Right.
Same thing like you're saying with crypto is how, like, what are you going to do? Like, if you screw up, you're done. Like, there's no one you can talk to fix it. Maybe you can now, but very few ways to fix it. And so, in my opinion, I think the way that it gets broad adoption is by making it stupidly simple for everybody, which the ETFs have done. But it's still kind of not simple for crypto. And I wonder in your kind of vision, like how long do you think it'll take before it gets stupidly simple for like, Joe and Susie Lunchbox who know nothing about, investing or technology and just want to participate?
I think it's gotten there in over the last year in a lot of senses. Now, we used a firm called Zero Hash for our custodian, and Zero Hash has done a really nice job of making the process simple. You can talk to them, etc. Again, when they're the custodian for you, you can do it through your brokerage account. It does put in a level of trust that didn't exist 5 years ago. So I think that now when people start using their own wallets, et cetera, that's where it can get a little bit more confusing where you're so much more reliant on yourself. But by doing it through a brokerage firm that uses a custodian, it really makes somebody accountable on the other end. And it really does help you. You get markets, you can get in and out. In my opinion, that's probably a more comfortable place for most people to begin. There was that joke 5 years ago, which was funny and in a sense probably true. It said, "Oh, good, Bitcoin. It combines all you don't know about computers with all you don't know about finance."
I never heard that. That's hilarious.
And I thought it
I
was a
like that.
great joke. But I think over the last year, we've really seen people start to understand it more. And like I say, I'm talking about Zero Hash because I've used them. I've seen what they can do. And a lot of brokerage firms do use them for their consolidated, for their custodian. And that's who you're actually doing the trade with and against. And they have all these different firms making markets, the same as you see on the stock market every day.
Yeah, no, it makes sense. So where do you see the crypto industry going? Because it's not just Bitcoin and Ethereum. There's like, I don't know.
Dogecoin and Sui and all the other
Yeah,
ones.
there's shit coins and then there's other
Yeah,
coins. Like there's all sorts of stuff. Like where do you think that's going? Like what does that look like 5, 10 years from now in the blockchain space, when it comes to finance?
I think it continues to progress. If you think about, I believe, if you include all the ETFs, et cetera, there's 10,000 different symbols that you can trade in the equity markets. Now, you might want to trade most of them. I shouldn't say most of them, but quite a few of them. But there are still 10,000 symbols. I think what you're going to see with crypto and with the different coins is we'll get to a couple of hundred. I don't know that we'll get much around that because and there are going to be 30 of them that just like with those 10,000 names, you probably only want to trade 200 stocks or ETFs or whatever it may be. I think we'll get to a few, 300 coins, and you're probably going to want to trade 30 to 50 of them. And, but there are people who have an interest in the other one, but your, Joe and Susie lunchbox, as you said earlier, for them, it's going to be 20 or 30. And the biggest thing about them is hopefully what people are doing in their equity trades and options trades and everywhere else they trade. There's going to be enough liquidity where you can get in, you can get out, and you don't get screwed in the process with giving up too much money to get in and get out. And that to me is always the concern. What does the liquidity look like? Can I get in and get out quickly?
I think it's a great point. Liquidity is so important and so underrated with everything. It's like me buying an option where the volume is 10. It's like that's not a good idea.
It's the difference between. I always use this example. There is nothing wrong. I'll use John Deere as an example. John Deere's a fine company, and the options market there. But if you go into John Deere as compared to Apple, a lot of people are trading Apple. Not many people are trading John Deere. You'll get a good market, but you're not going to get a great market. And Apple, you're going to get a great market. It's going to be 2 cents wide or so all day long. John Deere might be 10 cents wide. Why? Because the market maker, they have to go and buy or sell the stock against it. They're not out to screw you, but they're trying to take off risk too. So they got to go trade a stock that's 10 cents wide. Whereas an Apple, they go trade a stock that's 2 cents wide. So when, just logically, things you should think about those kind of things before you make investments.
Nice. Well, that's a good way to end it up. So, any final thoughts, JJ, as we wrap it up here, and then where can people find more about you?
Sure. On the X or Twitter at the JJ Kinahan. I've actually, for those who are new to options, I wrote a book about 10 years ago called Essential Option Strategies. If people want to get started there, I was at TastyTrade for the last 3 years, so tastytrade.com.
Nice. Well, I really appreciate you coming on the show, JJ. We'll definitely have you back on because the world's not going to stop spinning and people aren't going to stop investing in all these fun things. So appreciate your wisdom and yeah, we'll have you back on soon.
Thank you, sir. Have a great day.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room.
All right. Well, that was a great interview with JJ. Really appreciate him coming on the show. Now we're into the panel portion of the show where we have our very own Doug Hegren. Hey, Doug.
Hey, Kirk, how you doing today?
Good, good, doing great. And we also have our very own Barb Freeberg. Hey, Barb.
Hi, guys. So happy to be here.
Great. Well, glad to have you both. So, Doug, what were some of your takeaways from the interview?
My big takeaway is we're watching the democratization of trading hit escape velocity. I mean, JJ nailed it when he said retail traders now have better tools than any professional had 20 years ago. That's a truth bomb because it flips the old market hierarchy. The gatekeepers he talked about, traditional market makers, they aren't gone, but we've talked about this before. They've morphed into high frequency algorithms. And the retail crowd has stepped into a role we once thought only institutions could play. But this access isn't the same as wisdom. I mean, options were built for risk management, yet the meme stock echo chamber turned into a YOLO casino. JJ's warning, start small, you're going to pay for lessons, make sure you're not paying much, is the antidote. And the bigger philosophical wrinkle, when trading education is accessible as a YouTube tutorial, we're not just changing markets, we're changing the economy. Young people, they now see trader as a viable career path, which is exciting and a little unsettling. I mean, what happens to innovation in other industries when quick trading gains look easier than building the next big economy? So for me, the panel today isn't just about option strategy. It's about how retail access, high frequency trading replacing market makers, the cultural pool of fast money are rewriting capitalism's playbook. And the question I'd throw back to all of you, is this shift a healthy evolution, or are we laying the groundwork for the next systemic shock?
Yeah, no, I think that's great. Barb, what were some of your thoughts from the interview?
You didn't leave me anything else to say, Doug. I mean, that was so freaking good. Did you write that script beforehand? That's all I want to know.
I have a few notes here and there.
See,
AI, blame AI.
is
It was
that
all AI,
cheating?
Doug.
Yeah, right. Well, I'm going to come at this from a different perspective, which is I'm very familiar with his products from ThinkorSwim to the whole TastyTrade, Tasty Live, the whole portals. And if you want to learn about options or you want to become a trader, those tools are spectacular. And one of the things I love about the whole TastyTrade ecosystem is there is something for everyone who is in that mode, who wants to learn trading, who wants to understand options, and who wants to watch virtual traders. Now, I say this with a caveat, kind of like Doug, which is this is not for the faint of heart. It's not like learning how to set up an eBay store and then sell stuff on eBay. This is complicated stuff. And before you quit your day job, I would say there is a very big learning curve.
Yeah, I would agree with that. Options are wonderful and challenging at the same time. And I concur with Barb. I'm a fanboy of everything that JJ and Tom Sosnoff have done. I learned about options through Tom when he was at TD. So he actually, I shouldn't say that, at ThinkorSwim is when I first heard about them when JJ and Tom were there, and they had a great platform there, and then TD acquired them, and they had their tech and their platform, which was wonderful as well. And then Schwab's acquired them, and then they went off and did their TastyTrade, which I haven't followed, but they've always been wonderful with education, and it is I can't speak highly enough of the job that they do of the educating around options because outside of the OIC, the Options Industry Council or something like that, they do a wonderful job of education. But like these guys really, I mean, the OIC is more of a nonprofit, whereas obviously these guys are doing it for profit. But they do a wonderful job, and I've learned a ton just from like just following them over time. So if anyone really wants to learn options, it is a great free opportunity to follow the stuff they do. The education's wonderful. So totally agree. Um, so Doug, options aren't for everybody. And obviously we talked about a lot of stuff in the interview. Um, but risk management is more important than ever, given where the economy is now. Um, should people just jump into options, or are there other things people should be thinking about, or how should people be thinking about risk in a time like this? So just be 100% all equities and let's go to the moon. Like, how should people be thinking about this?
I think they should be going out to Reddit and finding the next big short squeeze, Kirk. I think that's that's how you should bank your future.
Wall Street
Um,
bets are bust.
that's right, exactly. Was it stonks, right? No, and I think that I've said this before and I say it again. I think there's a lot of different ways to look at risk management. Certainly there's kind of some of the traditional and again this is debate we've talked about the art argued around this as well, but modern portfolio theory philosophies of having certain levels of equities balanced by fixed income and other and other areas. And I think we've said that does that is in many cases been proven not to be effective. In some ways it can actually minimize your ability to get returns, but then all of a sudden everything's correlated on the downside. But it's something, right? And for the absence of knowledge and education, doing something is better than nothing. Vanguard, put out their Advisor Alpha white paper many years ago. They continue to recirculate, talking about the 3% alpha that's given from the education and the support that you get from advisors, and a lot of what comes into that 3% alpha is looking at risk management and getting that help in ways that you may not be thinking when you're emotionally invested in the highs, which are so powerful of a market that is, going in a positive direction, and forgetting about how those, that impact of when that turns the other direction. I talked about this recently with you on one of our other conversations. I've done the studies. I've looked at the numbers. I've modeled retirement income going into retirement. And if you had gone through a number of different market scenarios, such as the crash, the dot-com bust, the Great Recession, 2020, and in almost every one of those scenarios, the person that retired into that event after the event occurred, which is when most people are like, "Oh, now I've got to make change. Things have gone bad. I need to adjust." They actually ended up surprisingly much better than those that had retired or gone into it before. And why is that? Because the risk is always there. And not being prepared for that car crash coming up ahead of you is much more dangerous than once you see the car crash has already occurred, and then the traffic jam occurs and you can work your way around it more safely. And so I do think that, that risk management, and there's a number of ways to do that. Again, like I said, stocks versus bonds. That didn't work in 2023 when they raised interest rates and killed bonds. And we're still seeing challenges of that. And, groups like Morningstar have been saying this for the last 15 years, that interest rates were going to be a trap for fixed income, and that it could end up, what is more conservative, could end up being actually a more volatile and more risky portfolio. So I think other ways of doing this, just to kind of summarize, is asset allocation. That's not just stock investment allocation, but that is looking at things that are uncorrelated in different areas. The way you might use, and I'm not saying this for everybody, but annuities or real estate or assets or real estate or precious metals or life insurance or other things. Again, all work differently, are ways in which you can adjust or minimize the risk. Now, if you're going to jump into things like options, now, with retail investors having access to tools and education that was never available before, now you do have, you do have things, events that like the tariff day sell-off that you were both talking about, where retail investors acted more decisively than institutions. So we are now in a situation where there's more available, but you have to educate yourself. You're going to jump into these things, and you're going to get caught up in the euphoria, or like he says, you hear the great, or one of you did, I can't remember if it was you or him, the great stories of the person that made it. And you don't hear about all the other times they failed. Well, it's the same thing you hear on Reddit with all of these stonks. Again, the reality of it is you've got to be able to understand how to manage that risk. And and again, as they talked about in this, it is really important to get that education, to start small, to feel it, to understand, to minimize losses, to pay for the lessons cheaply, focus on managing risk, different types of strategies. If you're going to use options, whether it's vertical spreads, calendar spreads, different things that can define risk and limit, losses, understand your probabilities. Are you selling around as we talked about, 35 delta offers a balance of probability and premium, and buy value, sell junk, choose contracts with intrinsic value. Those things, if you're going to get into options, matter. And there are tons of places now to learn and to get into this and be taught slowly if you're going to go this route. And I love the one thing that was said, and I'll move it back to Barb and you. He made a comment, I think, Kirk, about you doing options early on, and you said kind of, got a little bit of a bad taste early, and he said you didn't have a discipline. I'm trying to remember exact words on that. That is absolutely critical. Every education I've seen on options, you make sure that you have discipline. Don't just try to do every options or every strategy out there. Figure out one that you can understand and be an expert at that. And that is going to be highly correlated to your success.
Yeah, I couldn't agree more. I think, cheap education. I had a cheap education for learning those things. Some people have expensive educations if you start with a lot of money. So I was fortunate I started in college. Barb, what about you? I mean, what are some things people should be thinking about? Do you think this is, everyone should go into options or other ways to manage risk in times like this, or how should people be thinking about it?
I think risk is really key, especially now. If you're invested in the stock market, let's go back to basics, because Valuations matter. And what that means is, for example, the price earnings ratio based on average inflation adjusted earnings from the last 10 years, or the CAPE PE ratio, which has been proven to be a strong measure of valuation, is currently near the highest that it has ever been. And in 1999, it was about 42. Now it is at 40. And typically, what happens going forward? At some point, stock prices revert to their historical means. Now, the mean CAPE PE ratio is about 17. We saw at the beginning of 2000 that stocks, they tanked for several years, huge losses. And by the end of 2010, the 10-year prior returns were negligible. I can't remember if they were in the single digits or they were actually in the negative digits, but they were negligible. And what that means is, when valuations are extremely high in the stock market, like they are now, it doesn't mean the stock market's going to drop tomorrow, but the probability of a decline going forward is much greater than the probability of continuing ascent of stock prices. So keep that in mind, and then use that data to develop a risk plan. Whatever it is, either paring down your stock holdings, diversify more. Bonds actually perform like crap for the past 10, 15 years, and that has to do with the fact that interest rates were super low. Now we're in a position where they went up a little in the past couple of years, and now they're coming down again. That's really good for bonds. Bond valuation will improve as interest rates go down. So don't throw bonds away and say they're crap, I'm never investing in them because the past 10 years were bad. Finally, let me wrap up by saying asset classes have their moment. In the past, we have had like a boom in tech stocks, a boom in large caps, crazy returns for a long time. Does that guarantee that's going to go on in the future? No, it actually means it's probably less likely. So I'm going to turn it back to Doug, which is, keep diversification in the forefront of your thinking. And if you are heading into retirement, I implore you, take some money off the table. Have enough cash for the next 2 or 3 years of your living expenses. So if the stock market does tank in the next 3 years, 2 years, 1 year, you're not going to be forced to sell your stock market positions after great losses.
Yeah, I think that's smart, Doug. I mean, Barb, I think that's a smart thing for people to think about. Most people don't want to take the money off the table when they're winning. It's like going to the casino, right? When you're winning, you don't want to take money off the table because you're like, I'm winning, and then you start losing. You're like, well, I'm going to make it back, and so it just turns into a negative spiral. So it's always good to take money off, but you have to be okay with saying, I'm okay with giving up some additional gains, because people get out and then they're like, well, I'm missing out. It's like, on what? You have money, as opposed to, fake money, which is money in the market, because you don't have it until you take it off the table, right? It's not yours. Until then, it goes up and down and it bounces around. But until you take it off, you don't know what you got. So go ahead, Doug. You want to say something?
Yeah, I want to add on to that because I thought Barb teed that up really nicely. So I have a philosophy that I'll talk about with clients. I call it the retirement income farm. Um, And I learned this years ago, kind of, tailored this around to a specific kind of analogy. But effectively, you talked about the 2 to 3 years of cash. This is a hard conversation to have with clients. See, again, most people, unfortunately, are not really that diversified. I mean, if you look at what they've got all my money in the 401k, got all my money in the IRA. It's all in the markets, whether it's bonds or stocks of some kind. It's all in the markets. They've done the studies. People don't hold a lot of other things that are alternatives. If we go back to the history of retirement planning, there's a saying some of you may have heard of, maybe not, called the three-legged stool. The three-legged stool was basically comprised of the assets and the savings you had, the social security or the pension system provided by the government, and the pension or other cash flow income instrument that was provided by your employer. And again, a three-legged stool is pretty stable. You take away a leg, it's a lot more wobbly. You have to continue to work to keep that stool balanced. And they effectively took away that leg when pensions went away. The individual that came up with the concept of the 401k has come out repeatedly and said, "I regret it." The reason he regrets it was twofold. A, it created just an absolute cash cow for the financial services industry. They've made billions and trillions of dollars over the history. But also, it gave employers a way to get a way out for the responsibility of their employees' retirement. Okay. Before, pensions were a defined benefit. In other words, we're going to contribute to this and we're responsible for the benefit you get. 401k is defined contribution. We're going to give you access to it. You get to define what you're contributing. The outcome is unknown. And so, what's that tie back into? The removal of that third stool, the wobbliness that that created. You have to then understand that if you've got your assets, and as Kirk just said, they're variable. They go up, they go down, they can go anywhere. It's fake money till you grab it. If the first stage of the retirement farm is the delivery truck, okay, if you have a farm, food's going to come in. That delivery truck is your Social Security or it is your pension. You have to look at how much you need. Let's just keep it simple and say it's $100,000 a year. If your delivery truck is $60,000, two Social Security payments coming in, that's a $40,000 gap. And what Barb was talking about with the 2 years, it's not 2 years, it's 2 years of what you need between what the delivery truck is delivering and 2 years and what you need in that 100,000, which means if it's 40, you need 80 in the silo. Now that's hard for clients because then they're like, but I'm not going to make any money off that. It's your insurance. It is the ability that if we go through a recession, we went 13 years where the markets were negative from 2000 to 2013. Okay. So that 2 to 3 years in the silo gives you something to where you're looking at the rest of your stocks. We'll call that the field. They get locust people. They get droughts. Okay. There's going to be times that field isn't going to produce. And so what's going to happen is if you need to go over to that field, you're going to start digging up the seeds. If you dig up the seeds, it won't regrow. So we've got to stay off the field when the field has been decimated by drought and disease and pests. The silo gets you there. Now you also have to have a haystack. The haystack is drying out. So this is about 2 to 3 years. That's going to be income producing instruments that can either replenish your silo or help feed or provide feed. And now the field doesn't get touched for anywhere from 5 to 7+ years, which is generally the average of some of the worst types of market conditions. So if things are great, if the field is producing left and right, there's tons you can harvest. Go grab from it. There's corn on the stalk, eat it. Beans on the vine, eat it. But when the locusts and when the drought have come in, you better not go eat your seeds, or you will not have a crop to go back to. That's why you have to have the silo and the haystack.
Doug's making me hungry talking about food. So just wanted to say that. Thanks, Doug.
It's a good meeting to have in a coffee shop or a cafe.
Yeah. Yeah, no, it's interesting. So, I mean, one thing Doug said before about the comment we made during the interview was we have better tech now than the institutions had at the beginning. I really love the fact. So there's two sides of this. I wanted to bring this up because I think it's really interesting. So we interviewed a guy, a legendary investor, Vic Speriendo, who made an average 70% a year for like 20 years. I forget the exact numbers, but something like that, with never a down year. Like crazy, unbelievable, great options trader, way back in like the 70s or 80s. But early on when you could do that. And he built a pretty good fortune for himself doing that. And, he talks about all the different things. If you go back and listen to the episode, I forget which one it is. I'll have to look it up. I think it's episode sorry, episode 246. So it was released in May 31st of 19. And so we talked a lot about like the history of it and when he started, and it was very different then. And there was a lot more arbitrage opportunities because people weren't as adept with options as they are now. Whereas now options are you're not finding the loopholes that you may have found before. You're not finding the gaps. It's pretty much as Barb said, it's probabilities, right? You're talking about probabilities in investing. And that's really what options are right now is probabilities. And if you understand math, if you understand statistics, if you understand probabilities, you can do quite well. The people I've seen do the best are people who are really good at math. And you don't have to be great at math, just to be clear. Options are a tool. If you're investing in the S&P 500, you can invest in the SPY, like as an example. You can invest in a mutual fund, like a Vanguard mutual fund of the S&P, which a lot of people do. Or you can invest in an option, or you can invest in futures. Like there's many ways to invest in the same vehicle. The question is how do you want to invest and what is the most appropriate for you? Now, for most people, I think ETFs are the cheaper version, and Vanguard was always the cheapest, but I think the ETFs are the cheaper version of their mutual fund. So as of right now, to my knowledge, ETFs are the cheapest way to invest in the S&P 500. But you may not want to have full exposure. You may not want to be all in 100% in equities in the S&P 500. You might say, well, I don't like the fact that I could lose half my stuff like 2008 or the early 2000s or any of those periods where it does happen. I don't feel like losing half my stuff. What should I do? Well, look at some other vehicles to do that, right? Maybe you should consider options. Options are a great way to do that. Options are designed to manage risk. One of the challenges about options that I've always found is that people look at options as a speculation vehicle. People look at futures as a speculation vehicle. I remember when I was 15, I got this sales letter. It was in a little book and I read it and it was a brilliantly written story. Anyway, the end result was, hey, open an account at my futures firm and we'll teach you how to do it. And it made it look easy and, talking about pyramiding and all this other stuff. And I was like, oh, this would be great. I knew nothing about risk. I was like 15. I couldn't open up my own account. It was like, I had just enough money to do like one contract, but of course, that goes against you really quick. So I didn't know anything, but they made it sound really easy. And, the challenge is I was looking to speculate. I was like, I'm going to make a ton of money. And of course, I didn't know anything. And this is back before like computers, when you had these, you had to literally wait for the paper the next day to see what the price was. Those were the days. So, when you think about like tech, old school tech, if you had the tech to get the prices on a ongoing basis, you had to be an institution. Now we're all institutional investors. We all have access to the great tools. Institutions don't have many tools better than us. I mean, they've got some, but they aren't things that are going to move the needle, right? They have access to research that we might not, because they spend a lot of money on research and they're finding stuff out that we don't. But besides that, we're pretty much on par with institutional investors from a tech perspective. So that's great, but it also flattens out the arbitrage opportunities. So how do you find opportunities? Well, if everyone's investing in the S&P, there aren't many. But if you look at small caps, institutions aren't playing there. A lot more arbitrage opportunities. We've had a few small cap investors on the show. So when you're thinking about the vehicle, what are you looking to accomplish? It's really important to understand the vehicle. That's why I love options. No matter what you want, you can create a option strategy from it. You want to make money when the market goes up and not lose when it drops, you can do that. If you want to create a strategy where you make money if the market goes sideways, you can do that. You want a strategy where you make money where it goes down, you can do that. You could do virtually anything you want with options. There's a strategy for it. But you have to understand the math. You can't just go out and throw stuff on and be like, all right, let's roll the dice. Let's get lucky. You can't do that because that's not how it works. But I would suggest if anybody's interested in options, and I think you should,
You don't do it to speculate, you do it to manage risk. If you understand how to manage risk, you understand probabilities, you realize, hey, I can do this better. Whatever your strategy is, I can probably do it better with options. Let me give you a quick example, and then I'm going to hand it back to Barb to wrap it up. Let's say, well, given the time frame of what's going on, we've had a rocket ship ride in silver in the last pretty much since September. It's pretty much jumped 10% in a short period of time, and looks like it's keep going. It's been a good year for silver. So let's say I think silver's going to the moon. Okay. What are the probabilities silver's going to the moon? Very low. So if I buy a call option because I think it's going to go to the moon, okay, I'm all upside. Everything's upside. I can go, it can go to $1 million and I'm going to make $1 bazillion in my contract. Okay, the probability of that is close to zero. So buying just a call option is probably not the best strategy. Well, what if I think, okay, it's trading at 40, it's probably not going to go beyond 44 in a month. That would be a lot to do in a month. Okay. So what if I sell a call at 44? Well, I'm limiting my upside. It means I can only make 10%. But what are the probabilities I'm going to make more than 10%? Really low. So maybe instead of it costing me $1, maybe it only costs me 70 cents for that contract. Well, now I've just made more money and I've reduced my risk because my outlay is 70 cents. It's no longer $1. So there's lots of ways. I know I probably confused some people, but I want to just state there's a lot of ways you can use options to manage risk. But really managing risk is managing the max amount of loss you can have in any given time. And most investors, their maximum loss is 100%. If you're investing in an index or a stock, your maximum loss is 100% of what you have in there. It may not probabilistically happen, but that is a possibility. But when you use options, you can define what your risk is. You can define your max loss. I only want to lose 2%. I'm okay with making 5, but I don't want to lose more than 2. You can do that, right? Whatever your thing is, you can figure it out. But anyway, I just wanted to state I have a lot of love for options because they're so flexible. But you do need to understand them. You do need to put in the work, the education. You can't just go show up and just throw money at it because they're way too complicated for that. But they're not too complicated to use once you understand them. So anyway, I'm going to wrap it up here. Doug, final thoughts from you.
Yeah, listen, you just heard me list out the framework of the retirement income farm. So let me leave you with this. If you haven't stress tested your plan for today's risk, you're planning for yesterday's economy. Inflation, stealth taxes, and surging college costs are eroding the wealth after tax. And high earners, you're not immune. Too many families are keeping their future tuition dollars in the field that I mentioned, gambling that the market won't cut them in half before the bill comes due. That is not a strategy. That is hope. Pull those dollars into the silo I mentioned early and manage the risk the way you do with retirement income. And here's the part that most people miss. When you run scenario tests on retirement income plans, like I said, time and time again, it's the risk you can't see ahead that's often more dangerous than the market crash you retire into. In other words, it's not the storm you see in the rearview mirror that does the damage. It's the one hiding around the bend. So ask yourself, whether it's options, whether it's your 401k, it's traditional asset allocation, risk management, are you still relying on yesterday's playbook, assuming that markets, college costs, and retirement income will behave the way they used to? If your gut says something's off, trust it. Be early to the trend of smart money. Visit our website to learn a little bit more, especially on the retirement income, mergentadvisors.net. That is MERGENT, mergentadvisors.net, or specifically for college planning, which, by the way, is a major part of the success of your retirement income, mergentcollegeadvisors.com. Build a plan that protects your harvest so college costs and retirement income aren't left to chance.
Awesome. Thanks for coming on, Doug. Barb, final thoughts from you.
I want to leave you with this idea of a pre-mortem. We all know what a pre-mortem We all know what a post-mortem is. A pre-mortem is assessing your current portfolio right now with a worst case scenario. So look at the assets you have. For example, let's say you have 90% stocks. Market is extremely overvalued. So I would say in a worst case scenario, you might see a 50% drop in the stock market. Or maybe if you want to be a little less dramatic, a 40%. And then let's say you have 10% bonds. And I would say in the current scenario, you're not going to see more than a 5-10% drop. Okay, you average those out given the percentages that you own, and you're probably looking at an overall 40+% drop should the worst economic scenarios happen. If you cannot live with that over the short term, and we're assuming that over time, markets will rebound and we will go back on to growing companies and growing asset prices. But if you cannot live with the potential worst case scenario today and wait for things to improve 5-10 years, then you need to adjust your investment strategy. And that is why diversification across asset classes, strategies, whatever, will really help you, because in today's market, the stock market is set up for low forward returns. Next 10, 20 years, I don't think there's anyone sitting on this panel today that is not going to concur with me that over the next 10 years, stock market returns are going to be below 10% and probably significantly below. So do a pre-mortem, manage your risk, diversify, and visit me, Barbara Friedberg, on YouTube and at Barbara Friedberg Personal Finance.
All right. Thanks for coming on, Barb. Appreciate it.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.